Welcome to Finance, Accounting and Banking. Final or financial statements, the balance sheet. This is a financial statement that shows the financial position of a business at a particular date as far as assets, capital, and liabilities are concerned. It is usually prepared at the end of a trading period or accounting period or financial period. Either 1 month, 3 months, 6 months, or 1 year, but most businesses take 1 year as the accounting period. Assets are recorded on the left-hand side of the balance sheet, while liabilities and capital are recorded on the right-hand side, or vice versa. You can present assets on the right-hand side and liabilities and capital on the left-hand side. The terms DR and CR are not used. The balance sheet takes the format of the balance sheet equation, which looks like this. Assets on one side, liabilities and capital on the other side. That is, the total amount or value of assets should be equal to the value of liabilities and capital in a business. They should balance. We'll see that as we move on. The balance sheet items. 1. Assets. This is a property of all kind owned by a business or an organization to which money value can be attached. For example, cash, motor vehicles, stock, furniture, buildings, etc. We have current assets and fixed assets. Current assets are expected to last for a short period of time, usually less than 1 year, and they are those items that are easily convertible into cash. And fixed assets are assets that are expected to last for a long period of time, usually more than 1 year. And those items are not easily convertible into cash. They are not for resale, but to help run the business. Liabilities. These are debts a business owes others. For example, money borrowed by the business, buying on credit from suppliers, loans unpaid, accrued electricity, unpaid salaries, etc. We have short-term and long-term liabilities. Short-term or current liabilities are the debts that are payable within 1 year. For example, bank overdraft, creditors, etc. And long-term liabilities are debts that are not expected to be settled within 1 year. For example, 3-year loan from a bank, 5-year loan from ICDC, etc. Then you have capital. This is money or items or resources required to start and or run a business. This is what the owner of the business can claim to be his in the business. It is also called owner's equity or claim. For example, owner's contribution makes up capital. Savings will also be brought in as capital. Borrowings make up capital. Capital can be increased by net profits and additional investments into the business, and capital can be reduced by drawings either in form of cash, stock, or other assets, or can be reduced by net loss. The format of a balance sheet. We have the T shape, the 3 lines, and here it should be balance sheet, not trading account. So the name of the business, balance sheet, and the period as a certain period of time. Then on one side we have assets, liabilities, and capital. Assets can also be presented on this side and capital, liabilities on this side. But this is the usual format. So assets, as we had said, we have current assets and fixed assets. So the sum total of current assets and fixed assets forms the total assets and written here. And examples of current assets, we have cash in hand, cash at bank, debtors, stock, prepayments or paying in advance. And then we have fixed assets like machines or equipment, furniture, plant, buildings or premises, and land. The total is presented here. Then we have liabilities and capital. Liabilities, as we had said, are categorized into two: current liabilities and long-term liabilities. Examples of current liabilities: we have creditors, bank overdraft, accruals, etc. And then we have long-term liabilities, examples: 5-year loan from a SACCO, 4-year loan from a bank, etc. And then we sum these up plus capital to arrive at a figure here that should be equal to this. And that's why we have balance sheet. And then don't forget that capital is increased by net profits made over the year or investments brought into the business for that period of time. Drawings and net loss also reduce capital when you do them during the year. So the total figure here should be equal to the total figure here, because a balance sheet should balance. An example: the accounting period of Kiwa Traders ended on 30th June 2013. The assets, liabilities, and capital were as follows on that date. Cash at hand, 4,000. Stock, 10,000. Furniture, 7,000. Creditors, 5,000. Long-term loan, 20,000. Premises, 50,000. Debtors, 2,000. Bicycle, 3,000. And capital, 51,000. Let's get to the answer. So we have Kiwa Traders title, balance sheet as at 30th June 2013. Assets. We start with fixed assets here. And the fixed assets given here are premises, a bicycle, and furniture. Premises, furniture, bicycle, and the total fixed assets. Then we have current assets. In our case, we have debtors, we have stock, and we have cash at hand. So stock, debtors, cash at hand, the total here, current assets, and then the total assets is the total of current assets and current and fixed assets, which is 76,000. Then on the opposite side, we have capital and liabilities presented. We've been given capital as 51,000. Long-term liabilities, we have a loan there of 20,000, long-term loan. We have current liabilities, we have creditors, 5,000. And the total comes back to 76,000. A balance sheet can also be presented horizontally. We will look at that later. Thank you for watching this video. Please remember to subscribe and like my videos, my channel. My name is Edward Kariuki Mathenge, kariukiedi2010@gmail.com.